When I was younger, I learned a lesson that has stayed with me longer than any spreadsheet ever has. The market often tells you what happened. A product tells you what might happen next. Most people reverse that order. They open a chart, they stare at a valuation table, they compare a few ratios, and then they pretend they understand a business. I never believed that was enough. A stock certificate is not the business. A price chart is not the business. A talking head on television is not the business. The business is the thing a customer reaches for when they need something done. The business is the habit, the dependency, the workflow, the switch that gets flipped every day, whether Wall Street feels optimistic or terrified. That is why the biggest money is often made before the crowd has learned the right language for the opportunity. By the time everyone can recite the right buzzword, a lot of the easy money is already gone. The pattern is older than people think. It was true in railroads, it was true in insurance, it was true in consumer brands, it was true in the personal computer era. It was true when the internet stopped being a curiosity and became plumbing. And it is true again in this period where artificial intelligence has captured the public imagination, but where the real opportunity is not in repeating the letters A and I louder than the next fellow. The real opportunity is in understanding where the demand becomes non-optional and which businesses get paid every time that demand expands. That is the difference between noise and signal. If you had asked the average investor what made certain fortunes possible, many of them would have pointed to the final headline. They would have pointed to the giant winner after it had already run tenfold. They would have looked backward and claimed the path was obvious. But it never feels obvious in the early innings. In the early innings, it looks messy, it looks overvalued, it looks risky, it looks too strange, it looks too concentrated, it looks like something the serious people will explain away until the serious people miss it. The money is not made by pretending the future is perfectly knowable. The money is made by understanding products, understanding incentives, understanding bottlenecks, and then waiting for the market to misprice the businesses that stand closest to those realities. That is why I have always respected the idea of a circle of competence. Not because it sounds elegant, because it keeps you from becoming a tourist in businesses you do not understand. A tourist can always find a story. A tourist can always find a metric. A tourist can always find another tourist to agree with him. But a tourist cannot tell you why the customer stays. He cannot tell you what breaks the business. He cannot tell you where the economics improve as the product gets more embedded. He cannot tell you whether a company is selling convenience, trust, security, scale, power, data, status, or merely borrowed excitement. And when the market gets rough, that ignorance gets expensive fast. I have watched people swear they are long-term investors right up until the first real drawdown. Then the speeches stop, then the philosophy disappears, then the stock that was a revolution on Monday becomes a mistake by Friday. You find out very quickly whether a person owns a business because he understands it or because it was going up. That is where most portfolios get into trouble. They do not fail because the owners are stupid. They fail because the owners never built a hierarchy in their own minds. They never separated infrastructure from fashion. They never separated habit from hype. They never separated software that can be copied from software that sits in the center of a mission-critical workflow. They never separated the company that rents out a feature from the company that collects a toll every time digital activity expands. Once you start looking through that lens, the field becomes clearer. You begin to see that a lot of the most interesting opportunities in technology are not really about owning the loudest story. They are about owning the businesses that get paid when complexity rises. That is a very different thing. In periods like this, people like to imagine that a single invention wipes out entire industries in one clean sweep. Reality is usually more nuanced. A new technology destroys some habits, strengthens other habits, creates entirely new dependencies, and forces capital to flow toward whatever holds the system together. That is why I pay so much attention to second-order effects. The first-order effect gets the headlines. The second-order effect often gets the profits. Take digital banking. A lot of investors looked at the old banking model and assumed the future would simply belong to the largest institutions forever. They saw branches, scale, regulatory barriers, and low-cost deposits. And they concluded the winners had already been chosen. But the customer experience was changing. Younger users were increasingly willing to begin their financial lives in an app rather than in a marble lobby. They were happy to check balances, invest spare cash, refinance debt, apply for loans, and manage savings through a phone. Once that behavioral shift became durable, a different kind of bank had a chance to emerge. That is what makes a company like SoFi interesting to me. Not because it carries a fashionable label, not because the stock can be volatile, not because management says the right things on a conference call. It is interesting because it is trying to solve a deeper problem. How do you turn financial services into a digital relationship rather than a series of disconnected transactions? The checking account is not the endpoint. The investing app is not the endpoint. Those are acquisition tools. The real economics appear when one relationship becomes many relationships. If a business can acquire the customer through a convenient front end and then move that customer into lending, cards, mortgages, and other higher value products, the economics begin to change dramatically. The business stops behaving like a one-trick app and starts behaving like a system. That kind of model can work very well if management stays disciplined. It can also hurt badly if the economy rolls over, credit quality weakens, and optimism outruns underwriting. That is the sort of risk you must keep in front of you. A financial business does not get the luxury of pretending the cycle no longer matters. If employment weakens, if delinquencies rise, if liquidity dries up, the story gets tested in a hurry. But that does not make the business uninvestable. It simply means the investor has to understand that he is not buying software with no balance sheet exposure. He is buying an evolving financial institution whose upside comes from deepening customer relationships and whose downside appears when the credit cycle reminds everyone that growth is never free. That is a very different proposition from buying a bank because it screens cheap on a website. Now move one layer over into software and the market begins making a different kind of mistake. The public likes broad labels. It likes to decide that all software is safe, then that all software is doomed, then that all software is reborn. That is lazy thinking. Software businesses are not identical. Their pricing models differ, their customer dependence differs, their replacement risk differs, their strategic position differs. A company charging per user for a narrow task is not the same as a company embedded in the security, observability, or network stack of a major enterprise. A company selling convenience is not the same as a company selling defense. That matters a great deal in an AI cycle. People are right to notice that some software will be pressured. When artificial intelligence begins replicating certain types of white-collar work, the businesses most vulnerable are often the ones whose value proposition was already narrow. If a product sells a seat that can be partially replaced by a machine, then the pricing power of that seat becomes questionable. If a product performs a task that an AI agent can reproduce cheaply, then the moat may shrink faster than management expects. But that does not mean the whole software landscape collapses. In fact, some categories get stronger. Cybersecurity is a perfect example. As offensive capability increases, defensive necessity increases with it when it becomes easier to generate malicious code, test exploits, search for weak points, and launch attacks at scale. The value of good security does not decline, it rises. A world with more intelligent attackers is not a world that needs less defense. It is a world that needs more automated, more adaptive, more deeply integrated defense. That is why a company like CrowdStrike deserves serious thought. I do not care that the market can get frightened about valuation in the short run. I care that the business sits close to a non-optional problem. Security is not a luxury line item when your systems run the enterprise. It is a form of continuity insurance. It is reputation insurance. It is operational insurance. And when a company builds a platform that does more than simply match known signatures, when it begins using machine learning to recognize unfamiliar threat patterns, then it shifts from reactive defense to something closer to anticipatory defense. That distinction matters because new attacks do not arrive politely labeled. The strongest businesses in this category do not merely keep lists. They build systems that learn. That kind of capability can support very attractive economics, especially when customers consolidate around platforms they trust. But I would be foolish. Not to mention the other side. Reputation is fragile in security. If the vendor causes a major outage, the damage can extend beyond 1/4 numbers. The customer is not simply buying software. The customer is buying confidence. Break the confidence, and the multiple can compress long before the income statement fully shows the pain. That is why quality has to include execution, not just market opportunity. The next layer is zero trust security. And this is another place where the market can miss the difference between a category and a slogan. I think of zero trust as a way of reorganizing how access works in a cloud-first world. It is less about chasing intruders after they get in and more about making sure identity, verification, and permissioning are designed correctly from the beginning. That sounds technical, but the economics are clear enough. As more work moves across distributed systems, cloud environments, and machine identities, the old perimeter model grows stale. If the architecture of the enterprise changes, the architecture of security has to change with it. That is why a company like Zscaler can become interesting. When enthusiasm drains out of the stock, the leader often carries a premium. The challenger or adjacent winner can sometimes be acquired at a better price, especially when the market decides to punish whole groups at once. I have made money in my life by remembering that the stock market occasionally has the emotional stability of a frightened child, It can get bored with a good business. It can get angry with a good business. It can decide a company is expensive one month and indispensable the next. The investor who knows the business can use that instability. The investor who only knows the price becomes its victim. Then you arrive at one of the areas I find especially important in this cycle, which is data. Everybody likes to say data is the new oil. That is an imperfect phrase, but it points towards something real. Data by itself is not enough. Untouched data is like raw material left in the ground. The real value appears when that data becomes visible, interpretable, trackable, and useful inside the operating machinery of a business. Once companies rely on increasingly complex systems, cloud workloads, and now AI agents that touch multiple data sources, the need to observe and organize digital activity grows. That is what makes Datadog compelling to study. A lot of investors hear the word observability and glaze over. That is their mistake. Sometimes the most valuable products are the ones that help every other product work properly. Those products can look boring until you realize they sit close to the nerve center. A business that gets paid as usage expands can be in a better position than one that gets paid by simply assigning a human seat. If data volume rises, if machine activity rises, if AI workloads rise, then a usage-based model may actually benefit from the very trend that frightens investors elsewhere. That is a wonderful example of why categories are dangerous and business models matter. Two software companies can both be called software, yet one gets squeezed by AI while the other gets strengthened by AI. The labels stay the same, the economics diverge. Investors who cannot see that distinction will either avoid the winners or overpay for the wrong things. And there is another reason the data layer matters. The market tends to assign all of the glamour to the visible intelligence layer. It talks endlessly about models, chat interfaces, and virtual assistants. But sophisticated operators know that the quality of any intelligent system depends on the quality, structure, and accessibility of the underlying data. If the data is fragmented, corrupted, delayed, or opaque, the intelligence on top becomes unreliable. In many systems, the data layer is the real foundation, and the flashier layer above it merely captures public attention. I have seen this movie before in different costumes. Investors rush toward what they can describe in one sentence. They ignore the less glamorous component until it becomes impossible to ignore. Then they reprice it all at once. That is why I spend so much time thinking about enabling layers. And once you think about enabling layers, you eventually run into an idea many investors resist. Most people should not pretend they can outpick the world all the time. I have never had much patience for the vanity that infects investing. The world is full of people who want to believe they possess a secret genius when what they really possess is a bull market and a short memory. Passive investing has done something very useful for the ordinary saver. It has offered a low-cost way to participate in the productivity of American business without demanding false heroism. Broad market funds are not exciting. They are not meant to flatter the ego. They are meant to compound. That is powerful. An index fund tracking the major American businesses can be a marvelous base for a lifetime of wealth building. It reduces the chance that a person ruins himself through overconfidence. It turns discipline into a system. It asks less brilliance from the owner, and therefore often produces better outcomes than a great many active strategies run by people who confuse motion with insight. The evidence for that is hard to ignore. Over long periods, a great many active managers fail to beat the simple patient alternative. Some of that is fees, some of it is taxes, some of it is behavior, some of it is the plain fact that the average person does not become more rational merely because a Bloomberg terminal is nearby. He carries the same old fears and urges into a more expensive room. That is why I have long admired the S&P 500 index as a practical tool, but even there, you must understand what you own. An index can become concentrated. A few giant technology companies can account for a disproportionate share of the weight. That does not make the index bad. It just means diversification is not a magical word. It is a real concept. And the investor has to decide whether he is comfortable with the composition. That is where international exposure can matter. That is where smaller companies can matter. A portfolio can be built with a sensible core and still leave room for additional growth, broader geography, or more targeted bets. There's nothing unwise about combining humility in your base with conviction at the edges. In fact, that may be one of the healthiest structures available to an investor who knows a few things well but does not fool himself about the rest. The trouble comes when people do the reverse. They build the base out of speculation and then sprinkle a little prudence on top for decoration. Now let me turn to one of the most underappreciated truths in this entire cycle. Artificial intelligence is not only a software story, it is an energy story. You can have all the model ambition in the world, all the data center blueprints in the world, all the strategic declarations in the world, but eventually the system runs into physical reality. Massive compute requires massive power. If demand for digital intelligence accelerates, then electricity production, power contracts, grid constraints, and fuel sources become part of the investment equation. This is where some investors make another classic error. They look at a modern technology boom and imagine the only winners must be the visible software names. They forget that every boom has picks, shovels, rail lines, copper pipes, transformers, and power plants somewhere beneath the glossy surface. That is where a company like Constellation Energy enters the picture. Nuclear power spent years sitting in an awkward place in the public imagination. It was controversial, politically difficult, slow to expand, and associated in many minds with old disasters rather than future opportunity. But when power demand rises and carbon constraints remain politically relevant, nuclear begins to look less like a relic and more like scarce strategic capacity. If the largest technology companies need dependable baseload power and are willing to sign long-term arrangements to secure it, then the economics of existing and restartable nuclear assets can become very interesting. That does not make the road simple. Nuclear is not a business for the impatient romantic. It is capital-intensive, politically sensitive, operationally serious, and vulnerable to any event that shakes public confidence. But those very frictions can create scarcity. Scarcity, in the right setting, can become pricing power. If it takes a long time to build supply and demand arrives faster than policymakers expected, the holders of existing assets may find themselves in a much stronger position than investors had assumed a few years earlier. There is a second wrinkle here that I find especially important. A transition does not happen in one clean jump. If AI demand outpaces the speed at which new nuclear capacity can come online, then interim power sources matter too. Natural gas can act as a bridge. The investor who understands that reality avoids simplistic narratives. He does not need the future to look pure in order to understand where the money may be made. He only needs to understand the sequence. Many fortunes come not from predicting the final state perfectly, but from recognizing the bridge that must exist on the way there. That same way of thinking applies to the Internet's infrastructure. People talk about the Internet as if it were a finished utility. It is not. It is an evolving system built on layers of old assumptions, patched together over decades, and now being stressed by new workloads, new security needs, new traffic patterns, and new forms of interaction between machines. When that happens, the businesses that improve traffic flow, security, routing, edge computation, and transaction capability can gain significance beyond what the market first imagines. Cloudflare is one of those businesses worth understanding. The simple description does not do it justice. A lot of investors first encounter the company as something related to websites or protection. But when a business begins sitting across security, traffic management, developer services, edge functions, and increasingly the architecture of how AI agents may interact with digital commerce, it is no longer just one narrow feature. It starts becoming a new layer of internet plumbing that can be extraordinarily valuable if it works. The reason I find this especially interesting is that the economic model of the internet itself may be changing for years. Huge portions of the web were supported by search traffic and the advertising economics tied to that traffic. But if users increasingly get answers from AI systems instead of clicking through pages, some of the old incentive structure weakens. That does not mean the internet disappears. It means the money has to find a new path. When the money has to find a new path, the businesses helping to redesign that path may become more important than the businesses optimized for the old one. That is why I listen carefully when operators talk about payment interoperability, agent commerce, edge execution, and efficiency of workload completion, rather than pure resource rental. Sometimes the winning company is the one that helps the system do more with less. Sometimes the winning company is the one that benefits when the architecture itself gets rebuilt. Of course, that kind of opportunity also comes with real uncertainty. A company betting on a new internet structure can be very wrong. Vision alone is not enough. Plenty of intelligent founders have imagined a future accurately but failed to capture the economics. So you must separate possibility from inevitability. Still, I would rather study a business trying to solve a real infrastructure problem than a business merely rebranding itself around the excitement of the month. Then we come to a part of the chain that few ordinary investors think about until it is already obvious. Semiconductor demand does not rise in a straight line. It often moves through bottlenecks. The value shifts from one layer to another as scarcity migrates. First, it may be the model developers capturing imagination. Then the chip designer captures it, then the foundry, then the equipment supplier, then memory, then some less discussed but absolutely necessary component. Deeper in the system starts constraining performance. That is why I pay attention to interconnects. If you keep increasing compute intensity, there comes a point where moving information efficiently between components becomes just as critical as the raw power of the components themselves. A faster brain attached to a weak nervous system does not produce the result people imagine. In data centers and AI clusters, communication pathways matter immensely. That can create opportunity for a company like Marvell. I am not attracted to it because it is a moonshot story. I am attracted to the logic of the bottleneck. When a business sharpens its identity around infrastructure pieces that become more essential as system complexity rises, it has a chance to benefit from a supply chain transition that has not yet been fully appreciated by the market. Optical interconnects, switching technologies, and the physical fabric connecting high-performance systems may not inspire the same cocktail party chatter as a chatbot, but they may be closer to the next squeeze point in the chain. That is how you have to think. If you want to avoid arriving late, you do not look only at what is celebrated. Now, you look at what the celebrated thing cannot function without. And yet, for all this talk of technology, infrastructure, and product understanding, I still come back to the same old discipline. You do not have to own everything. In fact, trying to own everything is one of the fastest ways to stop understanding anything. A sensible portfolio is not a museum of every interesting idea. It is a practical arrangement of exposures that you can actually hold through stress. Some core should be boring, some core should be broad. Some positions can reflect conviction where your competence is strongest. Some positions can express a view about where the digital world is headed, but the whole enterprise has to be built around durability of thought, not appetite for novelty. That is where a lot of people go wrong in technology investing. They think sophistication means complexity. I think sophistication often means proper ordering. First, own a broad base if you do not know much. Second, concentrate only where you truly understand the business. Third, distinguish between product utility and market fashion. Fourth, know the business model well enough to tell whether AI is helping it or threatening it. Fifth, remember that every digital revolution eventually runs into physical constraints, and whoever solves the constraint often gets paid handsomely. Those ideas are simple, but they are not easy because the market fights them every day. The market invites envy. The market invites hurry. The market invites the belief that someone else is getting rich faster, and therefore your own discipline must be old-fashioned. But old-fashioned discipline is still the most underrated edge in investing. When I buy a business, I do not need to know next quarter's narrative. I need to know what problem it solves, why the customer keeps returning, how the economics deepen over time, and what could break the thesis. If I cannot explain those things in plain English, I do not have conviction, I have entertainment. And entertainment is very expensive in this business. That is why I do not want a portfolio built only out of symbols. I want a portfolio built out of reasons. I want to know that one part of it captures the broad strength of productive enterprise. I want to know that another part of it captures the rise of digital finance where the customer relationship can deepen over time. I want to know that another part protects the digital world as threats become more automated. I want to know that another part sits in the data layer, where AI needs visibility, structure, and tracking to become useful at scale. I want to know that another part benefits from the energy hunger of the next computing era. I want to know that another part helps redesign the internet, so work can be done more efficiently at the edge. I want to know that another part sits near the next hardware bottleneck rather than the last one. When you think this way, stocks stop looking like lottery tickets and start looking like claims on recurring realities. That is the whole game. The public loves stories about genius picks. I have lived long enough to know that the real edge usually comes from more ordinary things, a clear circle of competence, patience, a willingness to let the broad market do most of the heavy lifting when it should, a refusal to confuse all software with the same business model, a habit of asking what the product actually does, a habit of asking whether demand is discretionary or non-optional, a habit of asking what happens if the future arrives faster than expected and where the pressure then falls. Those questions keep you honest. They also keep you from buying a hot label instead of a real business. In the years ahead, a lot of people will claim they saw this cycle clearly. They will say they always knew where AI was going, where power demand was going, where cybersecurity was going, where digital banking was going. Very few of them will be telling the truth. Most people see clean lines only after history has done the drawing for them. The investor does not need that luxury. He only needs enough clarity to separate the essential from the ornamental. So when I think about this market, I do not begin with a question most people ask. I do not begin by asking which stock is about to explode. I begin by asking where the world is becoming more dependent on secure systems, more dependent on trustworthy digital relationships, more dependent on organized data, more dependent on low-cost broad ownership of productive enterprise, more dependent on electricity for intelligence, more dependent on faster digital infrastructure, more dependent on the physical links that allow all these machines to talk at extraordinary speed. Once you identify those dependencies, you are much closer to rational investing than the fellow chasing the most exciting chart on his phone. There will always be pullbacks. There will always be dilution scares, outages, valuation panics, rate shocks, and periods when the market seems determined to insult your patience. That is part of the price of admission. Anyone can hold a winning stock when the tape is kind. The serious test is whether you can hold a well-understood business when the mood turns ugly and the reasons still remain intact. That is when understanding pays rent. I have never believed that investing success comes from sounding the smartest in the room. I think it comes from seeing the chain more clearly than the crowd, seeing where the customer begins, seeing where the money flows, seeing where the system gets stressed, seeing which businesses become more important as the system becomes more complex, seeing which companies have real staying power and which ones are simply borrowing excitement from the season. If you can do that, you do not need to chase every idea. You only need a few good ones, a sound base, and the temperament to let the mathematics of compounding work for you instead of against you. That is how I would look at this era, not as a scavenger hunt for ticker symbols, as a search for durable roles in a changing system. The labels will change. The fashions will change, the slogans will change, but the principle will not. Own the businesses that the future quietly leans on before the crowd learns how much weight they are carrying.